So today we will talk about daily trades, gain if any, AI bubble, and outlook for gold. So these are the trades done today, specifically on AMD and Apple, and I'll explain it in detail. So for October 8, 2025, AMD is once again up by right now $13.64 at $225.15. I did some of the trades on AMD. Now my thinking here is, although this is all well and good, but I will be still selling some of calls whenever the stock goes up like high like this. And the idea is to just take the premium because at the some point, um, the sold anything sold will expire worthless. That's in theory. So I did bunch of AMD trades today, thinking at some point AMD will come down. These are my trades, but I have just put it in a Word document so it looks more readable. Okay, we can start from, well, AMD at 225 today. First of all, I think AMD will come down at some point. So I sold one AMD February 2026 300 call for $10.40. That means $1,040 in my pocket. Today is October, so November, December, January, and February, 4 months. This is um, 300, so it's about $75, $65 more. If AMD goes up, then I will be in loss. But other than that, this should be good. Now, to get the insurance, because you don't want to sell naked calls, so I actually bought two of calls on the same expiry. So I bought one AMD February 2026 440 call at $1.94, and I also bought one AMD February 2020 26 450 call at 174. The reason here is, this is my assumption that AMD will go down at some point, but still you never know. This might pop up maybe another 50 $60. So I bought two calls. One of the calls I'm going to close early, and this another call I'll just keep it running in case uh, I need the insurance. So in total, I got net credit of $6.72 when you minus 194, 174 from this 240, 1040, then you will get the net credit. Now my goal here is, whenever I sell call, in most cases I'm looking for $500 gain. Um, and So even though I bought couple of calls, but they actually were financed from the call that I sold. So that's my theory. Whenever I sell or buy something, it should be net credit. Now, the market is so unpredictable because AI bubble is also here in a way. So to counter that, I also sold one AMD December 2026 180 put, because you never know, AMD might go from here. But 180 put seems to be a little reasonable right now because AMD is right now at 225. And so for this one, I received $30.40 as a premium, 3040. But again, I don't want to sell anything naked. That's the reason I also bought an insurance. So I bought a one AMD December 2027 90 put at 520. So $5.20 went out of my pocket to purchase this put. But at same time, I also got the 180 put premium. But again, as I said, I don't want to pay anything from my own pocket. So I also sold one AMD December 2027 100 put for 775. So in a way, 775 put will finance the 521. So the 100 put will finance the 91. My assumption is, and you can comment comment section below, most of the puts sold and call sold will eventually worthless. So that's the theory here. If not, if, say for example, AMD goes from 225 to 50, 60, $70 down, then the 520 put will somewhat provide me insurance. It will not be 100%, but again, when the stock is at 225, I'm selling at 180 put, and that's also maybe over 2 years of expiry. So there is some cushion here. There'll be some price fluctuation, but that's the theory here, that eventually all sold put and calls will um, s- be worthless at the end. Well, so that was on AMD. Again, it has gone a little bit up to 2626. So in addition to AMD trades, I also sold 5 shares of Apple at 257.27. Now my theory again here is, whenever stock goes up by $2, $3, or $5, I will sell a small quantity of shares from my account, and when they also go down for two, three, $5, and I'll just buy back. So it will be just a circular going on and on. But for this one, let me see what I got in my account. While I was looking for something else, the AMD is still going up. We looked at 225, now it's 227.43. So that was the reason behind my selling that 180 put. In case it goes up, then I'll be also making profit. If it goes down, then I'll be also making profit. So right now, just playing on both the sides, whichever it goes, up or down. So I was talking about Apple. I sold 5 shares of Apple at 257.27, and for that I got gain of $128 because I had purchased earlier. I sold it today, 5 shares, and that will be one of the strategies that I'll be employing, selling a small quantity of shares and buying small quantity of shares when they go down. So today I'm also going to track hot topic: is there an AI bubble forming? And more specifically, is there evidence of AI companies doing circular financing for each other, essentially funding one another to prop up valuations? In this video, I'll break down the theory, show you signs to watch for, and give you some trade ideas both for long and short based on how the things might unfold. So, what is an AI bubble? A bubble happens when valuations detach from fundamentals, when growth expectations are so aggressive that they become unsustainable. In the case of AI, many companies trade on future promise, revenue growth, AI platform adoption, data dominance, but not all are delivered. Circular financing is when companies use each other's stock or capital to prop up cash flow, investments, or cross-hold stacks. Essentially, they are lending strengths to each other rather than building underlying business value. This can make the entire sector more fragile. When one cracks, the others also suffer. For example, uh, the OpenAI recently made an announcement to invest up to $10 billion to get the 10% stake in AMD. And that's called the circular finance, where one company will put the money in another company, and the other company will also put in some other company, but they are in the similar sector. Next, we'll tackle on signs and red flags of circular financing and bubble behavior. The first one is cross holdings and stock for stock deals. AI company A acquires or invests in AI company B using its own inflated stock, not cash. The second is frequent convertible debt or stock based financing. This raises dilution risk. Third is sky high valuation multiples with weak free cash flow, which is like price to earnings or EV to revenue ratios for exceeding comparable tech sectors. The fourth is dependency on continual capital raises. If many AI firms consistently issue shares to fund operations rather than generating with existing business. And fifth is analyst skepticism, insider selling. That is founder or early investors selling large propositions positions. And the sixth is correlation breakdowns. That is when AI names that were tightly correlated begin diverging sharply. Good signal stress. Let's look at trade ideas, both long side and the short side. Now, long side, if you believe in AI continuation, and if you believe that AI is not overhyped or that certain names have sustainable moats, then buy select quality AI companies, ones with real revenue, profitable outlook, and strong balance sheets. Example will be NVIDIA, NVDA, Microsoft, MSFT, with AI cloud exposure, and Alphabet, GOOG, as diversified AI play. Or you can also buy long dated calls, that is lips, for high conviction names. You strike somewhat out of the money to keep costs down. Example will be buying NVIDIA 2027 call at a moderate strike. Or you can buy also an AI ETF if you want to exposure without single stock risk. You can go with the AI focused ETFs. Or you can also buy optional hedge long positions. That is, you buy long stock and short a call, that is a covered call, to reduce your downside risk. Next, we are going to tackle on the short side. So, if you believe the bubble will deflate, here are some shorts or hedging ideas. First one is short overvalue AI names. So, focus on AI companies with weak fundamentals, high dilution risk, or dependency on a capital raises. Second, you can buy long dated puts, that is lips as an insurance. For example, buy PLTR, that is Palantir 2027 put, if you believe it crashes. Or NVIDIA put spreads, that you can buy at a deeper strike and sell at a nearer strike to limit cost. Or you can also sell call spreads, or that is on AI names you hold or expect to stagnant. Or you can also use the out of the money calls with the low delta. You can also pair trades long-term relative values, that is a short weaker AI names with long quality names to hedge sector risk. Or you can use volatility products, that is buy VIX or implied volatility exposure if AI stocks get stressed. Next, we'll discuss gold. Outlook for gold at 4,000. Gold hitting 4,000 per ounce is a major psychological and technical milestone. It signals strong momentum, but as always, whether it can sustain or push higher depends on macro factors. Here's how I see things. Key drivers for supporting goals, that is central bank and official sector buying. That is, many central banks are diversifying reserves away uh, from bonds. This structural demand supports gold prices on the long term. The World Gold Council notes gold's strong performance year to date attributes gained partially to the institutional demand. Second is the weak US dollar and rate outlook. A softer US dollar makes gold more attractive for non US USD holders. Also, expectations of eventual Fed rate cuts can reduce the opportunity cost of holding non yielding gold. JP Morgan sees gold averaging 3,675 by late 2025, with upside towards to 4,000 as the rate expectation adjusts, which is we are already reached 4,000. Inflation, fiscal deficit, global debt, supply chain stresses, and geopolitical risk will, in near term, will uplift the gold. So my assumptions, and as per the some of the analysis report that I have read, the gold could go up to 4,900 from here. That is $900 more from here till the end of the year or maybe beginning of the year. Some analysts believe gold is now in a higher price regime. Even if there are corrections, the floor is elevated. And here are the risks for the gold: interest rates and real yields. If bond yields keeps rising or inflation surprises downwards, gold attractiveness can be weakened. Second is the US dollar strength. Any US dollar rally will put pressure on the gold. There may be also profit taking overbought conditions. That is, the rapid run up often provokes pullbacks. And the fourth is the policy liquefying shifts, that is, central bank moves, regulations, or sudden shifts in risk sentiments can also cause reversals. Here are the possible pathways. The base case: gold may consolidate above 4,000 with dips used as a buying zones. The bull case: pushed towards 4,500 to 5,000 range if macro and monetary conditions remain supportive. And the bear case,